Hi, everyone. It's a real pleasure to meet you and be with you, and also real nice to be with specialists that work in the retirement plan space. That's a special privilege for me. I enjoy that, people that understand how these plans work. So yes, today we're going to be talking about some of the practicals around cash balance. I know a lot of you have endured or perhaps enjoyed the 101 in the past. You know about cash balance, but I hope to peel back some opportunities for you to expand your business and to be a more valuable consultant in the qualified plan space. So do enjoy the program. I will be monitoring the chat box and the Q&A box both. So in order to make this interactive with as many people as we have on it, feel free to pose a question, and I'll try to toggle over to it and answer them. I'm going to go about 45 minutes and cover quite a bit, maybe a bit like a fire hose. But I know when I sit down to presentations, I'd kind of prefer a fire hose to someone who's overly wordy. So hopefully I will provide that for you. Is that fair? I hope so. All right. My name's Ken Guidros, as was mentioned. I've worked in the cash balance space for 20 years now, and I design plans. I field calls from people like you all that say, hey, my client is exploring this and wants to see if it's feasible. Because on the face of it, there's plenty of positive things about cash balance. As you can see in the subtitle, it has to do with taxes, right? And you as a business owner can enjoy greater tax deferral by pairing a 401k plan with this plan. And so that's why it can be so appealing. And that's what we do at FuturePlan, is we help you explore whether that prospect is feasible. Does it make financial sense? Does it make tax sense? Does it make broader sense given the nature of the business, et cetera? And so hopefully we'll cover all of those things today. Well, let me pose or start with this question. Why now? Why is this particularly interesting? And like I said, I've done this for 20 years, and I'm hearing more interest now than ever before. And I think it's a function of two things, and we'll talk about them in just a second here. Cash balance is growing fast. You can see there's almost 30,000 plans in the country. As compared to 401k, it's growing at a higher clip, which of course you'd expect, right? There's a lot more 401k plans, and so the percentage growth is going to be higher. But nonetheless, it's a growth niche in your area. And it's advisable for you to migrate into this area and at least learn about it, because there is a lot of saturation in the 401k space. And to grow a 401k business, I would suggest might take an alternative strategy, maybe a roundabout strategy. And that might be to lead with cash balance, or to lead in many situations with cash balance, and see if there's an opportunity there, even just to explore it. It may not fit, but when you as an advisor explore it in a reputable way, in a how would you call it? In an excellent way, I find that can then often open opportunities for the 401k plan, because you have demonstrated expertise and respect for the client by not bringing in a firm that's going to take a ton of resources for them to explore it. No, with our firm, you don't need a ton of resources. We can do it elegantly. We can do it time effectively. So because there's saturation in the 401k place, and as a defensive strategy, I think it can be useful to look at cash balance. You don't want someone else bringing up the subject. I just had a meeting last week where it was with a law firm. The person had the 401k plan, and they brought up cash balance. It was not a perfect fit. It might work, but I could tell it was for defensive reasons. He doesn't want someone else bringing up cash balance. And so he brought it up himself, proactively, had me on the call. We touched on a few things. It could work, but the take home that time was, you should better design your 401k profit sharing plan. and the partners can enjoy a benefit because they're already giving a 3% in the safe harbor. The partners can enjoy a 9% contribution in profit sharing. They were just getting 3%. So in that case, a defensive strategy resulted in a better designed 401k plan. It was a win for everybody, certainly for the client, and I think for the advisor. And then it's also about the taxes. As you know, there are current tax proposals on the table. And in some ways, there's always a tax proposal on the table, right? Yeah, we had a change of administrations. Midterms are a month away. Could there be some changes? Absolutely. But whatever happens, people are nervous and they want to prepare themselves tax-wise. Cash balance can be a great opportunity to do so. So those are some of the reasons I think it behooves you as an advisor to invest a little bit of time into being able to articulate the cash balance message a little bit better. All right, let's talk first of all about what exactly is it, and then I have 10 what ifs that are just a different way of looking at cash balance, kind of like a speed round, and maybe not just features of the cash balance, but where you can use it to market and to grow your business. All right, but backing up. So at its core, what is it? Well, it is a qualified plan that you all work in, and it's part of that right side of the slide. It's a defined benefit plan at its core. Most of you work in the 401k profit sharing DC side of the equation. But there is this other world, right, that we all know and love. Okay, love is in quotations. We all know and endure. Maybe that's a better word. And it's interesting. DB's been around a lot longer than DC, right? Been around it was the core of our retirement plan space. But in 1985, Bank of America reached out to the IRS and crafted a new kind of plan that today we know is a hybrid. And it borrows from the DB numbers, right? We get all these beautiful new numbers. People like me, I'm 62 years old now. A guy like me can do $300,000 in a DB plan or a CB plan, right? Now, not everyone's making this kind of money, but let's pretend I was making $500,000. The fact that I can shave my taxable income by $200,000, $300,000, $350,000, are you kidding me? That's really something. And so this new plan that B of A crafted in 1985 has become significant. There's 30,000 of them today. Federal Express has one, IBM, and Bank of America still has theirs, the same plan that was drafted in 1985. So it's kind of the 21st century version of DB. It looks and tests and smells a lot like a supercharged profit sharing plan. So, and this is just a schematic of how long it's been around. And I think it's an important thing to note that the government has tweaked cash balance and clarified cash balance often since 1985. So it's not something in the closet that has been forgotten about, that we're just squeaking in now, that we hope nobody figures out. No, this is a mainstream retirement plan in our country. And a CPA may query you and just say, well, listen, why don't I hear more about cash balance? Or why don't I know more about it? Well, they've been around. The IRS is approving them on a daily basis. There are 30,000 plans now. They're mainstream. And here are the numbers. And they're real. I mean, and I want you to notice, not just for people my age, but for the 30-year-old. The 30-year-old, it's still six figures, right? It's still six figures that they can put in a plan, 61 plus 70. And again, those will raise eyebrows. And I know that most of the businesses in our country don't have owners making this kind of money. I get that. But there are a lot making 300 and 400 and 500 that, can use a $100,000 deduction. And they want to become more retirement plan rich and not less company rich, but not solely company rich. And we're going to talk about even business transition here in just a minute. What if someone wants to migrate out of their business, gift it and sell it to the kids? Have a younger dentist come in and take over 5 years. So, those kind of scenarios are not uncommon. And the use of a sizable contribution like this to an owner can be very effective in transitioning a business. And I'm going to, again, talk about that in just a minute. But those are the numbers. They are highly age sensitive, but they can be very attractive even for the 30, 35, or 45-year-old. All right. Let's talk for a few minutes about how they work, what they look like. I'm going to choose. The details have been changed to protect the innocent, but this is a case I did about 5 years ago. It was in Texas. A lot of the features are the same. The demographics are the same. But I'm going to use this small case, and we're going to use it through the whole presentation. It's the only case I use. And you may say, well, Ken, my client is smaller than this. Okay, the principles still apply. You may say, well, Ken, my client's much bigger than this. Great, the principles still apply. So what we're going to talk about over the next few minutes applies whether it's a sole proprietor, a husband-wife, 5 partners, 50 partners, or 500 partners. It just doesn't change that much. So if you get this over the next 10 minutes, if you kind of understand the moving parts of what we're going to talk about, then you get cash balance. And I don't say that glibly. You get cash balance. You get the key variables. And I find as advisors, that's really all you need. You don't need to become an actuary. You just need to understand the moving parts in the illustration. And hopefully our illustration that's clean, that's got white space, that's got, in our opinion, and I realize we may be wrong, but in our opinion, has the main variables. All right, let's talk about it. Tammy and James, they run a gourmet coffee shop. Tammy's got her cup of coffee in her hand. James is looking at the numbers from her business saying, holy cow, people love coffee that much? I was in Starbucks after pickleball on Saturday. Yes, I'm a pickleball player. Is that the worst name for a great sport on the planet? But anyway, let's not digress into pickleball. But I was in Starbucks. I meet with my old fart friends after at Starbucks. I mean, it was person after called in order after. I just could not believe how much people love coffee. And I know that's so old for me to say, but it's just amazing. And this company was making really, really, really good money. All right. So these are the demographics. This is the W-2 that Tammy and James are taking, a couple back office employees. This was not a Starbucks. They were actually crafting the mixtures for the brewing of the coffee. Okay, let me confess. It was actually tea. It wasn't coffee. So they were importing these esoteric teas and crafting them into pretty cool medicinal and other types of blends. They had a typical plan that many of you work with, right? You want to max out the owner in a 401k profit sharing plan. Great. That's what you do, right? You've seen this all day. You've seen this 100 times. You've seen this 1,000 times. It doesn't take me or my company to do something special like this. Lots of TPAs in the country can do this. It's what I call a max out 401k profit sharing plan. That's a pretty decent number for Tammy and James, right? 6 figures, a deduction, reduction of taxable income. They got to give 5% to the staff, but that's a small price to pay. Okay, so here's the stage. Here's where I was called in. We have this, but we'd like more. Okay, what about this? What about adding 50 grand to Tammy's contribution, a little bit to James, the same 5% that was already going to the staff continues going to staff. It's not another additional 5, it's the same 5. Which, here's a marketing idea. If you know clients who are maxing out the profit sharing plan, pose cash balance to them. It's nothing, no more in profit sharing at least. I mean, come on, think about that. You can do another 50 grand, even potentially 70, even potentially 100 grand in cash balance for the same 5% of pay to staff? Yes, you can. It's a little known secret, but it's true. Now, is there an increase because some staff, not all, but some staff are now added to cash balance? Yes. I didn't say it was free. I just said it was potentially cost effective. So again, let me just recast that. If you have a client with new comparability, that's a phrase a lot of us know, right? And they're maxing out the 401k profit sharing plan, maybe they should add cash balance for a little additional money. So that's marketing opportunity number 1. For example, I used to be at a company called Kravitz. That's where I cut my teeth. Dan Kravitz and we started, he brought me in the mid 2000s, 2005. I shadowed him for a year and then kind of created what became known at Kravitz. 500 cash balance plans, some very large 1,000 partner plans, but also a bunch of one-man plans. We went through our whole book of business, all our 401k plans that were maxing out the profit sharing. And we just, I don't remember, it was maybe 30. We just started calling them. And a bunch of them said, hey, I'd love cash balance. Yeah, I mean, if it's hardly any additional money and I get another $50,000 to $100,000, of course I'd love cash balance. So this is what I would call entry point cash balance, what you see in front of you. And it's entry point because the cash balance number is not the huge number you may be used to. All right. What if Tammy says to you, that's great, but I heard you can do even more with cash balance. Like I heard we could really, really sock away some money, like in the hundreds of thousands. Yep, that's what this would look like. This is what I would call a maximum cash balance. Tammy can do her age-weighted maximum, 300 grand. So in this case, they were making really good money. They were an S Corp, and Tammy was taking about 300 in W-2. This is what Tammy and James wanted to live on, so roughly 370. So that's what they took home out of the company to live on, to pay their mortgage, to travel, whatever they did, right? But there was still about 400 left in the company that would have been reported on their K-1, right? S Corp, the pay is reported to the owners as W-2 and as not earned income on the K-1. But cash balance, what a cash balance does is essentially lowers the K-1 income. And so that's where the cash balance is funded from. This was beautiful. This was just what they wanted. Now, notice the next box to the left of it. The 5% of pay, it went to the staff. It went to the staff. And so was there an increase in cost? Yes. James and Tammy got another 356, but a little bit more went to staff. And the same cash balance went to them as the earlier illustration. So, is there more of a give to get the big numbers? Yes, because we have to satisfy non-discrimination, just like you all are very accustomed to do with even vanilla 401ks. You got to satisfy non-discrimination. And so the way we do it is we give a little bit more to staff. And the second test, so there's 2 tests when you add cash balance. And again, if you get this, you get cash balance. Number 1, what you see here, the profit sharing going up. But you say, well, Ken, Brandon Sarah, Ryan, and Jimmy aren't getting it much cash balance. True, but we're satisfying it in profit sharing. The IRS lets me aggregate both plans for testing purposes. So now I've got a big non-discrimination test, a big clumpy with both plans. I run all the ratio percentage tests, the average benefits test, right? I run them all in this great big old spreadsheet. Boom. If there's age disparity like you see here between the marshals and the staff, look at the age difference. What's the average? 58 of the owners. What's the average down below? 30, let's call it 37. 58 and 37 is a big difference, 20 years, right? So that's where I get my magic as a tester, as a TPA. All right, so this is cash balance, and those are the moving parts. You may say, well, Ken, that's pretty simple. That's it. And let me just tell you, so this, notice the byline here on this slide. This is what we send you. If you reach out to us and you say, here are the demographics, here's the census, can you run an illustration for me? Yes, we'll send it to you. And as long as you understand these 4 sections, then you can talk about it with your prospect or your client. And if it goes well, you can say, let's talk to the actuary or let's talk to FuturePlan, and we'll design it on the spot. Now, I know that, I'm biased. Okay, I get that. But to me, that's a pretty good offering. Because here's the thing. You probably don't know this company that well. You may know Tammy or James as not a personal client, but maybe as a 401k client. But there are things about the company that you don't know and you can't know to ask that they're going to want to ask in doing this. So let's just go through the 4 rectangles. Number 1, Tammy and James, you can select the amount you would like to do in this plan. It doesn't have to be the big number. It could be 200. It could be 100. But you will need to select it, and we're going to ask you to stick with it for 3 years. If something happens, you can amend it. But for the purposes of our discussion, we're going to ask you to plan on this for 3 years. Tammy says, great, we're doing really well. I'm bullish about the future. I'm going with 300. James says, fair enough, but we don't really have 350, we have 300. James says, I don't want to do any cash balance. Great, that's that decision made. Box number 2, we have to give in order to get. We have to satisfy IRS non-discrim testing. So Brandon through Jimmy get a profit sharing contribution. You can vest it. You can have a 1-year wait on the profit sharing, but you got to give it once they're a bona fide employee and a long service employee. Okay, the 11 grand for us getting what we're getting, that's a small price to pay. By the way, how long can I vest it? You can vest it out to 6 years. I don't think I want to do that. Can I do it shorter? Yes. You can do it 2 years. You can do 4 years. Let's do 2 because these people are really helping me. I like them. Let's just do a 2-year vest, 50% a year. Great, no problem. Oh, I'm sorry. There's actually 5 boxes. So I'm going to say, see this 700 per? There should be a box there. So that's the 3rd decision. We can either have everyone in at a small amount, or you can favor Brandon or Sarah or anybody, or you can just give them a contribution. We're going to talk about that in just a minute. So that's box number 3. Box number 4 is percentage of contribution to owner. How tax efficient is this plan? This is roaring. This is mega tax efficient. But you're not always going to get a 97. You're going to get an 80. You're going to get a 73. And you need to have that discussion with them. Is this compelling tax-wise? I don't know. Let's talk about it. Do you mind giving money to your employees? Well, they actually don't appreciate it. And I gave them a match last year, and they spit in my face, and nobody contributed to the 401k. And quite honestly, I'm kind of pissed at them. Okay, well, then maybe we don't want to do 7.5% of pay. If it's good money after bad, and they're not going to appreciate it, okay, then let's look at this and talk about it. So that's that box. And so the fifth box is really the tax savings box, and the discussion about this is going to reduce your taxable income. It may make you eligible for the 199A deduction if you get your taxable income under roughly 300 and a quarter, or 350. Again, it's beyond the scope of this presentation to dive into that discussion, but it still gives you, as an advisor, a chance to have the dialogue. All right, so this is what we send you. A few questions. Do we have 1 or 2 page marketing pieces that can be private labeled for you? As long as you share our name, yes. What's the advantage of using cash balance for contribution of $700 for the employee instead of adding it? Well, we are going to have to satisfy the 40% rule, which I'm going to talk about in just a second. So everyone can get a small amount, or one person, because 40% of 6 is 2.4, rounded up is 3. So 3 people need to receive cash balance. Tammy and James are 2 of the 3, so I need somebody, and I'm going to talk about that. Do you have an email template we can send to clients and prospects to grab their attention? Also a great question. Yes and no. I've done it a lot. I'm not doing field work quite as much now. I'm more consulting with people like you. But yes, our people are sending out emails all the time. Leah, would you mind reminding me, and we'll follow this up. So folks, keep the questions coming. I will pause occasionally and answer them. Fair enough? All right. Let's talk a little bit more about this range of contribution, because this may be the most important thing that you have to consult with your client on, and that is, Tammy and James, how much do you want to do in cash balance, and what's your obligation to the future? Just think about it, folks. We don't all have great years. Now, they're interested in cash balance because times are good. They're not even talking to you if times are bad, right? The times are good if they're talking to you about cash balance. But anybody who has good times knows that in the past there were bad times and there were lean years. And so showing Tammy and James that there's a range of contribution, but once you decide on a number, you can't just tweak it every year. The range is not an annual range. Now, okay, let me finish my discussion, and then I'm going to show you one little trick. Okay. You're going to have to settle on a number that you're going to try to stick with for a few years. That's a reasonable narrative. I'm showing you the maximum, but you can choose less. Now, if something happens to you personally, you're partially disabled, company has a lean year, there's COVID hits, a recession hits, anything like that is what we would consider a hardship. You can make adjustments. You can amend, freeze, or terminate. When COVID hit, we froze a lot of plans, hundreds of plans, because come on, we were all nervous. We didn't know what this would look like. So that's how you articulate the range of contribution. All right, let's talk about 10 what ifs. And this is a new thing I'm doing, so I hope you like it. What if Tammy and James had no employees? Could they do a cash balance plan, and a big one? Yeah, they could. Profit sharing takes a haircut. That's the one exception. Profit sharing takes a bit of a haircut, but look at the cash balance numbers. They can be handsome. What if they're only 35 and not 61 with big cash balance numbers? Does the profit sharing still take a hit? Yes. Could they add an after-tax bucket to mitigate the hit? Yes. I'm not going to get into that today because it's a lengthy discussion, but just This is the same illustration you would send to them. And by the way, marketing and prospecting with profitable sold props can be very, very lucrative. I hear a lot of great feedback about that. We produce these all day long. What if the person has a side hustle? Let's pretend it's a physician with on-call service that she does on the side. So this is an actual case. It's an ENT doctor, part of a medical group, and she's one of 10 partners. On the side, she does on-call service in the evenings and weekends. It's contracted directly with hospitals. It's not part of the ENT practice. Great. You can have a second cash balance plan. All the same principles apply. This could be an attorney. This could be a successful business owner who consults on the side. They have a side business. There's a difference in ownership. That's important. And there's a difference in where the business comes from. In other words, it's truly consulting business. It's not just an amalgam of the real day job. It's actually a different business. And interestingly, they have two $3 million lifetime limits. So on the day job, there's a $3 million limit, and on the side hustle, there's a $3 million limit. So again, a potential good marketing opportunity. What if the sponsor has a lean year? We just talked about that, but let me just delve into this. Of all the things I'm going to say today, you being able to articulate what I'm going to talk about right now may be the most important thing. You may say, well, Ken, wait, this is the bad news on cash balance. This is the opposite of why they're talking to me. True. But anybody worth their salt is worried about a lean year. I'm still worried about lean years, and I'm freaking 62. My wife's retired with a pension from teaching, and I still worry. I know that's a personal problem, and I'm dealing with it. But come on, anybody who's been around knows that times aren't always good. So you have to be able to articulate this. Amend, freeze, terminate. That should be a phrase on your lips. You can amend, freeze, terminate. Now, you have to do it by 1,000 hours, by roughly June 15th, but you can do it. FuturePlan reaches out to you on May 1st to see how you're doing and how the business is going. Are you nervous? Like we did with COVID. In April and May, everybody was nervous, so we froze. Now, many of those people unfroze in October because the year turned out to be pretty good for them. In fact, ironically, many of them made more money than they ever had. Whole nother discussion. But it's a way to manage the risk. Number two, an S Corp, the contribution can be tied to the W-2 pay. I know, you're getting excited, just like I am. Folks, look back up at this illustration. Tammy can tie her $300,000 in cash balance to her W-2 pay. Here's how it's worded in the plan document. Tammy's contribution is $300,000, but not greater than 100 or 99% of her pay. Well, guess what? Next year, it's a leaner year. Tammy decides to take $100,000 in W-2, and she decides to do it in December. She has naturally tiered down her cash balance to $100,000 without a plan amendment, and she did it in December. Yes, I know, you're tingling with excitement that can happen, and yes, it can happen. So for S Corps, it's elegant. It's beautiful. It's a little trickier with sole props and C Corps and other. It can still be done, but it's just trickier. And again, a little beyond the scope of this presentation. Number 3 and 4 are important things. You can contribute less and be underfunded without the sky falling. Let's say Tammy's contribution is $300,000. Well, the minimum required is, as the plan matures, becomes pretty small number. It's not 300, it's 100, it's 50. And so she can maintain an underfunded plan. This is a little known secret that a lot of people don't talk about, because us as actuaries, we like 100% funded plans. And there are sometimes, if it's a big company, especially multiple partners, there are ramifications of an underfunded plan. But for this kind of plan, a Tammy and James plan, there's very little downside. So anyway, I just want to communicate to you that there are options if Tammy and James have a lean year. What if Brandon is highly paid and not what we showed earlier, 51 grand, and 7.5% of pay becomes very expensive to him? Well, you don't have to pay him. He's becomes a highly. And anybody over 140 grand, we can give them just 3% of pay, or even we can exclude them. So there are options with high paid non-owners. What if we don't want everyone in at $700 per? Great. We could just have Brandon in. Gets a little more than 700 because he's older and higher paid, but we're satisfying, remember, we're satisfying two tests. What was the first one? Somebody type it in the Q&A box. No, I'm just kidding. Non-discrimination. But we're also satisfying a 40% test, which says 40% of the 6 people, 2.4, rounded up to 3 bodies need to be in cash balance. Sarah, Ryan, and Jimmy don't. So that's one. You could give them 700 per, or you could give one person 1,500. Now you may say, well, Brant, that feels a little exclusionary. Great, then give everyone a small amount. All right. Next, what if? And I'm sure you're loving these what ifs, right? These are making all this information, this fire hose of information more digestible, right? I see 2 questions in the Q&A box. If you have any questions, pose them. I'm going to stop in just a second and answer them. But what if I have a big company? In fact, what if Tammy and James had 40 people? Is the plan feasible still? Yeah, maybe. I'm sorry, I didn't mean to say yes. I meant to say maybe. $2 million of salary, 7.5% of pay. Come on, Ken. Yeah, maybe. I don't know. 2 to 40 seems high to me. The fact that Tammy's 61, okay, that helps. Her number's big. James could actually take more than 56. Let's pretend we got James up to 100 or 200. Okay, starting to get interesting. Maybe giving 150 grand employees. My question to you, if you brought this to me, is, are the 50 people going to appreciate it? Does it meaningful? Is it just a giveaway? And you say, no, they don't care. They could give them, 100% of pay and they don't care. They just want cash for the weekend. Okay, well, maybe not then. This may not pencil out. And you're going to find us at FuturePlan, we will be honest with you on the feasibility of the plan. Now, you're going to be honest with the client anyway, so I'm not bragging. I'm just saying, though, that I don't want an ill-fitting cash balance plan any more than you do. But if they have a lot of employees, let's talk about it. Maybe some of those 40 could be excluded. Maybe there's a front office and a back office. Maybe there's a Phoenix location and a Tucson location. And Tucson is not, we really don't need to give them. Well, I could do some interesting things there. All right, another what if. I know you're dying for the next one. What if the business is transitioning? Let's just pretend that Brandon is a new dentist, and this happens to be a dental practice. Tammy can't stand looking in people's mouths anymore, and she wants Brandon to take over the practice in 3 years. He wants to buy the business. Let's just pretend it's valued at $1.5 million. The dental practice is. Think about this. We can get Tammy 900, let's round up with interest, $1 million over the next 3 years in a cash balance plan. If Brandon will forego some of his income, he's going to reduce his W-2 to 150. He's going to forego 100 grand. He's actually producing quite well. Let's say he's generating $200,000 $200,000, maybe $300,000 worth of business, he's going to say, you don't have to pay me the 300. It's going to go in your cash balance plan. But we're going to value the company in such a way that's a reasonable proposition. I don't want to get too into details because you cannot legally buy a company with pre-tax dollars. We all know that. However, can we structure the deal in such a way that we know that big bucks are going to be flowing to you over the next 3 to 5 years? Yes. And that's what I can help you with, and FuturePlan can help you with. And it, again, has to be done above board, has to be done right, has to be structured correctly, but interesting things can be done when you have those features. All right, the final what if. What if it's a big group? Yes, it can work. We have plans, about 200 plans, cash balance plans with very large partnerships, 100, 50, 200. I'm working on a case right now with over 1,000 partners. And it's elegant. It works beautifully. Now, does it take expertise? Yes. I have a bench of about 4 consultants who have worked on these plans for decades. And, we bring them in and they figure out how to make it happen. And lots of details. Oh, I have one last what if. I hope this is my last one. Let me just check. Yes. No, I have 2 more. Look at that. You can tell this is the first time I've done it. I didn't know all my what ifs. What if the age disparity is not as perfect as you showed earlier? What if the staff is roughly the same age as the owners? Does the same magic occur? No. Sorry. Does it mean you can't do a plan? Not necessarily. But the magic that I use goes away. So we're going to have to be more creative. If you have such a census, send it to us, and we'll tell you whether we can do our magic. Now, what if the entity type is different? What if it's an S Corp or a C Corp, partnership, LLC taxed as an S Corp, whatever? The entity type does not matter. Let me say that one more time. The type of entity does not matter. All entities in our system can sponsor a cash balance plan. All right, we're going to go into investments in just a sec, but let me answer this. Oh, I'm sorry, that was you responding to me. If you have any questions, pose them. Awesome. Okay, folks, let's talk about your job in the equation. You run the money. We build the pipe. You handle the water that flows through the pipe. Fair enough? I build the pipe. We build the pipe. You handle the lake of water, the investments that run through. You consult with the sponsor to draft and to find something appropriate, of which there are turnkey options, or you can find something individually handled. We run the account balances. We provide them with an annual statement, and in most cases, daily access to their account. Now, it's only changing once a year, so it's not like people want or need daily access, but nonetheless, it is what it is. And the investment target is 4 to 5%. So if you hit over that, great. In fact, let's talk about that. What happens if you outperform over the 4 to 5? Then you're slightly overfunded. You have more money in the plan than you need. That's a great problem to have. What if you fall short? What if it's a year like this year where you come in at 0 or -5 instead of 4%? Well, you're slightly underfunded. And you will need to, you might need to catch up one day. But Tammy and James could maintain an underfunded plan for the entire duration of the plan's life. Let's pretend that James and Tammy are supposed to have $2 million at the end of the plan, but their portion is only $1.8 million. They could agree to take less. They are underfunded, and they just agree to take their 1.8. or they could true it up at the end. They have options. And so the funding status of a plan is not anything to lose sleep over. Let me just say that one more time. The funding status of most plans, certainly the Tammy and James type plan, is not anything to lose sleep over. Now, if you're in a partnership, it matters more, but even there are things that you can do. And I'll just pause here for just a second. You know, we've managed these plans since the early 90s. And we weathered the dot-com bust. We weathered the recession of '08. We weathered COVID and numerous recessions or small recessions in between all those times. And these plans work. We're not getting plans spinning off and terminating, you know, every year. Our book of business is pretty much yes, it changes, it migrates, but it lasts. These plans work. All right, let's talk about a little bit more about your job. There is a new option, and that is a floating or an actual rate of return. So instead of the 4 to 5%, your return, the internal actuarial credit, is tied to the performance of the portfolio. How's that for good news? Yes. So it grows 5%, the credit's 5%. It shrinks 5%, fine. The credit is 5%. Excuse me, minus 5%. I meant to say minus 5%. So this is an option. It's not for every company. It's not for the Tammy and Jameses of the world. Because again, we're overthinking it to give it to them. It's more for the medium to larger size plans. But again, if you come to me and you say, Ken, I have 2 partners and we want to do an actual rate of return plan, great, we'll do it. We can do it. We can make it happen. There is a principal preservation rule, but again, beyond the scope of our presentation today to kind of delve into that. But suffice to say, you can employ this kind of return or this kind of interest crediting rate. So let me suggest a couple things in a nutshell that you should look for in prospecting. I'm going to actually add a 4th to this. Number 1, high income. Number 2, a good ratio of owner to staff. 1 to 10 is good. Remember the earlier one when we had 40 employees and it was just James and Tammy? That was 2 to 40, so 1 to 20. It's a little bit high. That's a lot of money going to the owners, employees. I got to make sure I get enough to the owners to make it feasible. So a good ratio is number 2. Number 3, good demographics of owner to employee. And I don't need everybody to be 22, right? I don't need all the employees fresh out of college. No, you could have a 60-year-old. Tammy and James could have easily had a 60-year-old as an employee. Not everyone can be 60 or I don't get any leverage, but I want good demographic. And then the number 4 thing to look for is what I mentioned earlier, a max out 401k plan. Somebody maxing it out. That's a great prospect to at least have the discussion. And it doesn't cost you anything working with us. You could reach out to us and say, hey, listen, I don't know if this pencils out, but can you can you tell me if this works? And we'll run it. It's 48 hours and no cost to you. Don, if you could just pose in the Q&A box, I'd appreciate it. He raised his hand. Jeff, you asked, what if rank and file are underfunded? Yeah, you're going to have to fund them up. But remember, the rank and file, their account balances are tiny compared to the owners. So Jeff, you ask a good question. Okay, James and Tammy could agree to take less, but what about my rank and file? No, they're going to get what they get. So, that's a good point. Thank you, Don. When in the year does the CB have to be set up for the tax year? Okay, that's a good question. So it has to be set up before you file your taxes, and it can bleed into next year. So if someone wants to do a 2022 plan and they kind of forget about it, or they just don't, they're late and they don't think about it till March of next year for this year, they could do it. Now you say, well, Ken, what if it's, it's got all these, the 401k plan has all these features that are hard to wiggle out of. Yeah, you're not going to be able to wiggle out of anything, so it's still good to look at it this year. But you could draft, and you may say, well, Don, you may say, what if they go on extension? Can they decide later in the year even? And the answer is yes. So that's kind of a cool feature. But I still encourage you to use this fall to query for cash balance, because then we can craft the plan in the way it should be in the year of. Two other people raised your hand, so pose it in the Q&A box, folks, if you don't mind. I'd appreciate that, and I'll get to those in a second. All right, we got about 9 minutes, and I'm going to end on time. I told you I was going to go for 45. I knew when I said that was probably not going to happen, and I was right. All right. So what does FuturePlan provide for you? The best selling piece for cash balance is one thing and one thing only. It's an elegant illustration that you see in front of you. It's the single best piece. What about a great white paper? Nope. What about some great marketing literature? Nope. What about a cool looking plan limits table? Nope. Right here. Right here. And I learned this the hard way, right? So when I went to Kravitz in 2005, we used to bring a folder full of stuff. We would stack, remember that? For those of you who've been around a while, you'd stack the folders, you'd put your collateral material and here's who we are, and blah. You know what we did around the board table? All we looked at was the illustration. They pulled out a pen, they started drawing on it. They started, what about this? What about that? And that's what we provide for you. And we do it within 48 hours. And it's color-coded. It's just like you see in front of you. The best selling piece on cash balance is right in front of you. And then the second thing that I think is valuable is we support you on a Zoom call or a conference call. I have sold cash balance plans now for, I don't know, 10, 12 years since I was really in the field, just over the phone. It is amazing how quickly people will trust you. If you know what you're talking about, and if you respect their time. I've been shocked how many things they'll tell me about their personal finances within 5 minutes. If I was disingenuous, I could probably hurt some people. Right? They open up to you because you know what you're talking about, and in 10 to 15 minutes we can design a plan. So Tammy, here's what happened. So Tammy says, well, listen, James works for the company, but to be honest, 65 in W-2 is the max we can give him. Great. Can he do more? Could we actually do more than 56 for James? Yeah. How much do you want to do? Well, I mean, heck, we'd love to do 200. Great. Well, and I would talk that through. I'd say, tell me about your staff. You want everyone getting a small amount in cash balance, or is Brandon the back office manager? Yeah. He's been with us for a long time. Well, you don't have to give everyone 700. You could give him the only cash balance if you want. Oh yeah, that appeals. Or no, that doesn't appeal because they all talk to each other, and I don't want to favor Brandon. Okay, great. We'll just give everyone a small amount. So that's what we do over the phone. Is we design the plan right there. And we talk about the lean year, always. Anyway, so you don't have to be a cash balance expert as long as you work with us. All right. And this is the local support we offer. This is being updated all the time. I'm in California. My colleague Carlos is in New York. The two of us are the cash balance specialists, and we support all of our field people throughout the country. This is up to 35 locations. If you want to work with your Minnesota person or person in Oregon or Texas, whatever, you can do so. But we'll be behind the scenes as FuturePlan. And here's your due diligence. Go to our site, cashbalancedesign.com. Include CPAs in the discussion. They're the biggest advocates of cash balance. And there's the rough fee range. A sole plan is going to be about $2,500 a year. The Tammy and James plan, about $4,500 a year. A bigger plan, $6,500. So that just gives you a range. Is it Walmart? No, we're not Walmart. Is it reasonable? Yes. Are we Wyatt or Hewitt? No, we're not, the big firm that's going to charge triple that. We're right in the middle. We're going to give you a reasonable fee for a reasonable plan. All right. I'm going to answer questions, and then I'm going to give you 2 ads just real quick. What if the owner sells the business in 2 years and the buyer doesn't want to keep the CB plan? Fine, end it. Terminate it. It's done. It's used its useful life. If you started a plan in 22 and sold the business in 24, that's what you meant. Yeah, fair enough. 2 years is quick. We may want to go 1 more. I like 3. That's just me liking it. There's no IRS law. And then Don, you asked about the fees. Yeah, here's the fee. And is it related to the number of participants? Yeah, but that's the small number. That's like $100 a pop. The big number is the base fee, which is roughly $4,000. The other number is a per participant. So that's that. All right, folks, you've been great. I appreciate your questions. If you have any more, you can reach out through Leah. Even if you want to do a quick 15, 30-minute call and talk about your business, I'm even happy to take that call. Just reach out, email me, and just say, hey, Ken, can I have 15? And we'll do it and talk about your business and how you can use cash balance. That's what I'm here for as a specialist at FuturePlan and cash balance. All right, folks, let me give you 2 ads for ways you can piggyback on what we've talked about today. I'm the cash balance coach. So if you like this presentation, you'll like the coach. It's here in a couple weeks. Actually, next week it starts. 101 is similar to what we talked about. 201 dives in a little deeper, investments a little deeper, and then marketing is on the 13th. That goes into how you can grow your business. And if you may not want to do it, but you may have someone in your office that's growing and you want them to invest the time, have them do the coach. And another specialty product that we do, and this is really gaining traction, is 316. It has to do, of course, with all the mechanics around cash balance and zipping up the compliance, and doing so at a very shockingly reasonable fee. And our team is really good at this. It's robust, it's dynamic, we have decades under our belt. So this webinar is also interesting, and that's on the 1st of November. And Leah can pose or can share the details on that as well.
Thank you, everyone. And like I said, if any questions come up after this call, or if there are any questions since we're out of time, please submit them to the support team and we will get those answered for you. With that, have a great day, everyone.